that, I will point out that it is March 24th, 2021, and so the data Mark is looking at is from the current year. You're not in a time warp. Mark?
Yeah. And it would be an odd thing to pull out the data from a year ago and try and present that, because the world certainly looked different a year ago than it does today. But anyway, thanks, Doug. As Doug said, I'm Mark White. I'm an associate extension professor with the University of Missouri Extension, and I'm happy to be here now. This is I guess the third year that I've done this kind of presentation for what was the Labor Law Breakfast, now the Labor Law Series. And in any case, now is a really interesting time to be looking at kind of the employment situation here in Missouri, because we are basically a year removed from normalcy, quote unquote normalcy. And we can begin to see what the last year kind of looks like. We have February data at the national level. There's always a lag in producing data, but we have February data at the national level. And last Friday, the U.S. Bureau of Labor Statistics released January data for metro areas. So that's a lot of what's incorporated here in this presentation. And those are good kind of periods of time, because as we think about, at least like nationally, January was the last full month kind of nationwide before things started to go south, and Missouri was like a lot of other places where things kind of went south a year ago in March. So in any case, we'll just to give you a sense of what I'm going to talk about here over the next 45 minutes or so. I'm going to start just to look at a few basic national trends, just for some context setting, and then I'll look at some state and regional trends. And this not only helps us understand what's going on in Missouri, but also helps put Missouri's performance in some kind of broader context. As I've done kind of in the past, I'll then spend a little bit of time looking at what happened in manufacturing and construction over the course of the past year. And then before thinking about kind of what the future holds, I want to spend a little bit of time thinking about some of how these trends have impacted young people entering the workforce, so those new workers. So as I said, those national trends help us set some context of where we've been in the last year. And last June, when I was doing this presentation, we had just gotten the data for, I guess, April. And to say it was grim was a little bit of an understatement. So the chart that I have here, and just to help you understand what you're looking at, the yellow bars are basically kind of month over the year change. So where we were in the most recent month here is February. So where we were in February of 2021 relative to where we were in February of 2020. And then and so on. So then January over January. And then the black line is just total employment change. So what we see, is there was a huge drop. And that's, huge drop that happened in March into April. We ran into we ran off a cliff, we ran into a wall, we ran into, any of the other kind of fates that befall Wile E. Coyote in any old Roadrunner cartoons. That's kind of what happened to the economy in April of late March and April of last year. And then things started to open up a bit again in May, when things kind of started to come back, but without a vaccine. A lot of the service activities were not going to, like restaurants and some of those things were not going to be coming back. So any recovery really kind of stalled out, and these trends kind of show up again and again. So as I run through this presentation, I think one of the things to be prepared to see is a lot of that reverse square root sign that's there. Now, one of the things that I kind of just want to keep in mind is that as we kind of, I think we can safely say that we're probably at the beginning of the end. We're certainly not at the end of this thing, but we're at the beginning of the end of this. But we're still a lot of work that needs to be done. So, right now, when we look at the national economy, we're still down 9.5 million jobs of where we were last February. So that's a lot. But hopefully with the vaccines rolling out, there's reasons to be kind of optimistic that a lot of those jobs will will come back. But yeah, last year was a a heck of a year, because it was the Spanish flu of 1918, the stock market crash of 1929, the civil unrest of 1968, all rolled into 1 year. And again, I'm not telling you anything you don't know, but yeah, it was something. So anyway, we're still, as that's the key point again, is that we're not, we're still down by, we still have 6% fewer jobs than we had last February, and that's a lot. The employment picture reinforces the notion that we're only halfway back as well. As many of you know, that there are kind of different ways to define unemployment, kind of our standard unemployment rate, which is basically measures, the number of people who are out of work but are actively looking, who are in the labor force, out of work and are actively looking for work. That's 6.2% in February. And then we have other measures of unemployment that are out there that take into account things like marginally attached workers, who are only able to find sporadic part-time work, or people who are discouraged workers who have kind of fallen out of the labor force, and that number tends to be high. And so during the height of last April, during the height of kind of the economic crisis, that was well over 20, so more than 1 out of 5 people were basically out of work. And now we're kind of down to the point where 1 out of 10 people are still effectively out of work. And the labor force overall, the U.S. civilian labor force, we're still down about 4 million workers, and that's about 2.6% that we're down. So again, there's still, nationally, as we think about this, there's still a lot of work that needs to be done. So moving on into probably areas of more kind of immediate and local concern, we'll talk a little bit about some state and regional trends. And so this is what the picture looks like. The picture looks like for Missouri over the course of the last year, and that we're down. Basically between February and April. So like during when we hit that wall, Missouri lost 357,000 jobs in about a 2-month stretch. And that basically means that 12% of the state's jobs disappeared, just kind of quickly disappeared between February, March, and April. And that, that's a lot. And far greater than any loss that happened during the kind of the Great Recession. Now, since then, Missouri has gained back. We kind of reopened starting in May. And Missouri gained back since that time, between say May and January of this year, gained back about 236,000 jobs. And so that's about 2/3 of the net jobs that were lost have been gained back. So that's the good news. So, I mean, I guess the situation, basically the way I would explain it is, we're no longer we're now in a Great Recession sized hole rather than a pandemic sized hole. And so I guess that's your glass half full or glass half empty way of looking at things, but there's still a lot of work to do. Now, another way that we can kind of look at the situation, again, getting back to that reverse square root symbol, is we can look at the employment population ratio, which basically describes the proportion of the adult population who want jobs and their success rate in obtaining jobs. It basically multiplies the labor force participation rate times the employment rate. Hello? Hopefully. Anyway, and so anyway, again, it gets us a sense of a little bit of like the health of the labor market, because it takes into account not only how successful people are in finding work, but how many people are willing or interested in participating in the labor force. And again, when we compare ourselves to the nation, the kind of the fall here wasn't, the collapse here wasn't as great as it was nationwide, but we're still not back to where we were in those pre-pandemic levels. And the same thing applies for Missouri's labor force. We're still down, about 70,000 some odd workers. In January 2020, Missouri had a 3.1 million person labor force, and in January of 21 this year, it was 3.04 million. So, it's down 2%, but 2% is better than what it had been the year before, which was, I think closer to about 10%. So, significantly, some real gains made in kind of coming back. Now, it's good to kind of benchmark ourselves to the nation, but it's often maybe a little bit more helpful to compare, where is Missouri relative to other neighboring and Midwestern states? Basically just asking the compared to what question, or we're down in terms of our employment in Missouri. We're down 4.3% from where we were in January of last year. So the question is that good or bad? And generally speaking, within the context of kind of the middle of the country, it's pretty good. We're below the U.S. rate of 6.3%, and we're not nearly as bad as what you find in Michigan, in Illinois, and in Minnesota as well. So some of those upper Midwest states have really kind of had it worse than what we have. When we if we want to drill down a little bit into into metro areas, the same thing kind of applies. And the general rule of thumb is that everyone's hurting, but it could be worse. Again, we're gonna ask a lot of glass half full, half empty kind of questions here. And I think when you see kind of in the previous slide, particularly in like Minnesota and Illinois, that those were the states that had lost the most jobs since last January. It's not really that surprising to see Chicago and Minneapolis also suffering, given the prominence of those metro areas in those states. And for some of it, Chicago, if you're kind of familiar with some of the growth trends facing a lot of the major metros, the 10 or 15 largest major metros in the state, Chicago is one that has been, it's a huge, economy, it's a huge economic engine, but it is growing nearly as fast as it's kind of going in the opposite direction as like Atlanta and Dallas or Seattle or some of those other larger cities that are growing fast. But yeah, when we look at the big metro areas in Missouri, you can see that St. Louis is still kind of not as bad as the nation overall, and it's kind of on par with what we see in like Louisville or Oklahoma City. Kansas City is doing kind of a bit better, and it's kind of on par with Memphis and Indianapolis. And then when you go down to kind of southwestern Missouri, which also gets into kind of northwestern Arkansas, you see that things there kind of have not been nearly as bad as elsewhere in the country or elsewhere in the Midwest. So I guess we can take, again, it's kind of a glass full, half full, glass half empty approach. Now, that being said, no, Missouri metro area has yet returned to its pre-pandemic employment levels. And I think that's kind of consistent across the country, though, generally speaking, right? But we're all still down from where we were, January to January, we're still down. St. Louis has lost the most jobs, and that's kind of a big deal for the state of Missouri, just generally speaking, because St. Louis is far and away the state's biggest economic engine. It's 45%. The counties of the Missouri counties of the St. Louis metro area are 45% of the state's GDP and 35% of its population. So it really kind of drives what's going on kind of in the state. So getting St. Louis fixed will go a long way to helping the entire state recover. The other metro area that has been kind of consistently kind of down more than other metro areas, or kind of, I wouldn't say below average, but had bigger declines than other metro areas in the state, has been Cape Girardeau. And part of the reason with Cape Girardeau is that it's kind of the far and away the smallest metro area in the state of Missouri, with about 43,000 some odd jobs. So if you lose a few thousand jobs there, it's a lot more significant there than it would be a few thousand jobs lost in St. Louis, for instance. But yeah, in terms of just sheer numbers, if you're looking at like the metro areas like St. Louis, for the entire metro area, including kind of the Illinois side, the St. Louis metro area is down about 76,000 jobs from where it was last January. And Kansas City, again, Missouri and Kansas is down about 41,000 jobs. Missouri overall, again, just as we showed earlier, is down about 125. So like a lot of those losses are happening in some of the cities, metro areas. Now, if we think about like getting out of the metro areas and just thinking about the state, just generally speaking, in terms of where, where we tend to see some of the economic pain, we can look at unemployment rates, recent unemployment rates in January. And so, Missouri's unemployment rate is below the U.S. National average, so 4.3%. It's the highest areas are in the state's recreational areas. So Taney County and Stone County have the state's highest unemployment rates. There are also, if you go kind of around the Lake of the Ozarks area, Camden County was 7.6%, Morgan 6.8%, Benton 7.2%. And that's not really uncommon. The kind of the seasonality of those particular places lends themselves to having these like high kind of bumps in unemployment, particularly in January is kind of as off cycle as it kind of gets. So that's not altogether surprising. But again, by comparison, last April, the unemployment rate in Taney County was, I think, in excess of 25%. And again, that's just the unemployment rate, not like kind of the broader measures of unemployment in those areas. So there was some significant pain in those areas. And I did a presentation for a group down in the Lake of the Ozarks area a couple of weeks ago. And when you look at just like the labor force numbers in those areas, obviously they kind of spike during the summertime as people come in to work seasonal jobs. And it's kind of like the seasons. It's just up and down, up and down, up and down. And last year, it really that kind of normal summer spike really got squashed. So it was kind of not a great year in some of these recreational areas. So we'll see how what this summer holds, which odds are will be better. If you're looking at the low unemployment rates tend to be in some of the more rural areas. So like Gentry and Worth counties up in Northwest Missouri, Osage was relatively low. And then when you get into your bigger counties, St. Louis City was 7.1%, so kind of well above the state rate and above the kind of the national rate as well. And then like St. Louis County was kind of above the state but below the nation. Over in Kansas City, the same kind of applies for Jackson County and Clay County as well. Greene and Boone were below kind of the other bigger metros in Missouri, were just below the kind of the state average. So obviously, last year, the last year hit a lot of different sectors differently and at different times and in different ways. Right, the pain of the job losses wasn't evenly distributed throughout the economy. And of all the big sectors, it should probably surprise no one that transportation and utilities grew over the course of the last year, because as we all have stuff delivered to our house more than we used to. So just kind of the boom for Amazon, as people were spending more time at home because stores are closed, or also because people are not spending money on holidays because they're not traveling. We have a lot more stuff brought to us. So transportation utilities grew over 4% between January 2020 and January 2021. At the other end of this is the leisure and hospitality industry, kind of down at the bottom here, which includes hotels, restaurants, entertainment venues. And these businesses have really borne kind of the brunt of the economic crisis, and we'll surely lose a lot when we'll lose a lot when this is all said and done. I mean, some of those kind of like music venues or entertainment venues that are kind of part of whatever the kind of social and cultural fabric of our communities, not all of them are going to be coming back, and will be kind of the worse for it. But overall, that that industry is down over 56,000 jobs since January of last year. So that's 18%, down 18% from where they were last January. But if you want the good news, when I went back and looked at kind of the presentation that I had done last year that had the April data, they were down, it was down 50%. So again, we're back about 60% in that, in that industry. And the challenge with leisure and hospitality is that it's also typically an industry where there's a lot of people who are working part-time, or people who do not make a lot of money. So they don't have huge savings to ride this out. They don't, or they're working for tips. And if people aren't coming in, they're not, earning money through tips. There are also folks that don't have the benefit of working like we do via Zoom. And they likely, they don't have those extensive savings to ride this out. So, really as a kind of a group of folks, they've definitely suffered kind of more than most. Other industries that we're kind of down, that are down in terms of big numbers too, include things like government. Now, government also includes like public schools. So actually, for instance, my job would fall into a government job because I work for a public institution, University of Missouri. With tax revenues being down because the economy has been down, it's been really tough for state and local government, and anything kind of funded through state and local government funds to kind of maintain that employment. So that's another area that's been kind of down. And I'll talk about manufacturing here in a little bit because given generally the audience for these kind of presentations, manufacturing and construction are two of the industries that are kind of most relevant to a lot of folks in the room, so to speak. So we'll focus just to look at some of the trends facing those particular sectors. And in manufacturing, you can see that there's kind of we had, like everywhere else, we had we kind of slammed into a wall last April, big decline. And some of that I would imagine is manufacturers figuring out what they have to do to operate safely, to be open and operate safely. And so, a year ago, when you look at the kind of the nadir of the crisis, Missouri's manufacturing sector had lost about 35,000 jobs between March and April. St. Louis, kind of the broad Illinois and Missouri metro area, was down about 10,000. Kansas City, the metro area, was down about 14 or 15,000. So again, it's not as bad as it had been. So, we're now down about 2.7% from where we were, and kind of slowly creeping back up. Those jobs, aren't as bad. St. Louis is down 4,000. Kansas City's down 15,000. So Kansas City's had kind of that big kind of bump back, more so than St. Louis, or has come back faster than St. Louis has. But they're slowly kind of creeping back. So again, it's not great, but it's better than what it was. When we look at what are the different types of industries that have been affected within manufacturing, again, it varies from from sector to sector. So again, if we go back to where we were last April, every sector was down. There was no kind of gains in any particular manufacturing sector. Transportation, equipment manufacturing was down 24% from April of 2020 to April of 2019, and now it's running ahead of where it was last January. So that's a good thing. Food manufacturing has been relatively down slightly. It's been relatively consistent over the last year. That it didn't lose. It didn't lose a lot of employment. Still down, but it didn't have like the huge declines that there was experienced in some other manufacturing sectors. And some of that is just generally, food manufacturing is one of those industries where people got to, it's kind of essential, like people got to eat. So, demand remains kind of pretty inelastic for food. So In other other industries, things like, fab metal and machinery, I mean, they've been relatively consistent with some of the losses they've had last April. So they've stayed down a little bit more than some other manufacturing sectors have. So, overall in manufacturing, we're not back, but we're trending, hopefully trending in the right direction. Now, moving on to construction. Missouri's construction industry is down about 2.5% since last January. Again, that's an improvement over where we were, like at the pits of this, the economic crisis to come with the pandemic, where it was down 8.5%. And just going from like last March to last April, there was 11,000 jobs that were lost in kind of 1 month. So, that was a big decline. But what we see just since last January in the state of Missouri is that building construction is actually up 1,200 jobs. That's about 4.3% over where it was last January. A lot of those, the jobs in that particular part of the construction industry tend to be, bigger projects, maybe with a longer time horizon. Unlike some of the trades, they're maybe less impacted by changes in consumer spending. So, that's been, I think, a bit of a bright side. And then in terms of the specialty trades, they're down 3,200 jobs from where they were, again, last January. So pre-pandemic employment levels. Now, when we think about, okay, well, what does this look like, in different parts of the state? So the chart that's here, basically the gray is probably the one to focus the most on. That's kind of your month over the year change. So January 20 to January 2021. And then the kind of the gold bars are the more month over month change. So December 2020 to January 2021. And that tends to be a little bit more bounces up and down. And again, just kind of a little bit of a function of the data. When we get more detailed like this, we don't get just construction. We have to look at it as a group of mining, logging, and construction, although construction is the vast majority of the employment that's there. And so, we see that statewide, there was a slight increase in construction jobs in Missouri, even though there were kind of declines in St. Louis and Kansas City and even Springfield. Over the last year, Springfield's the only kind of metro area where mining, logging, and construction had any kind of net increase over the between pre-pandemic to kind of present. So January 20 to January 2021. So, I think one of the things that this tells me is that where there's a lot of any kind of growth in the construction industry has been kind of generally outside of the metro areas, and really for the construction industry as a whole to kind of reverse that, we need to get our metro areas kind of back in gear. So anyway, I want to move on just to it's kind of one kind of additional topic that I wanted to just kind of throw in here. So like over the last half hour, that's kind of the state of what things look like in the economy. But one of the things that kind of we've been toying a little bit, and some of the things that we've been looking at that I wanted to share is thinking about a little bit about new workers, because where we are in the economic cycle can really impact the career trajectories and career choices that young people make. I mean, it's it's one thing if you're coming out of high school, or if you're entering the job market, whether it's out of high school or out of college during a good time, a good economic cycle. That can have real implications for kind of your career trajectory, as opposed to coming out of, entering the workforce during a down time. So I wanted to just think about that a little bit. And the first thing that I wanted to just share with you is a chart that we pulled together based on information from the Missouri Department of Elementary and Secondary Education, which one of the things that they do is they'll survey basically students 180 days, so basically 6 months out of when they graduated from high school, to get a sense of what did they decide to do once they left high school. Did they go to a 4-year institution? Did they go to a 2-year did they, enter the workforce? Did they join the military, et cetera? And so, basically in 2019, which is the most recently available data, almost 1 in 4 Missouri high school students had entered the workforce upon graduating. But I think the interesting thing is when you go back kind of over the course of the last 2 decades and you look at what happened to, what, coming out of recessions and how that impacted people's choices. I think that one of the things that you see is that coming out of recessions, that more high school students are tend to go into a 2-year, pursue a 2-year degree. So community colleges tend to be a little bit counter-cyclical in that sense. And some of that is, maybe the job market, coming out of a recession, the job market isn't really that strong. They're also competing with a lot of people who have been out of work. So, it's safer to kind of just go back to, or it's a better choice to go to, a 2-year institution. And we see that kind of coming out of the 2001 recession, and we see it coming out of the Great Recession too. And then as the economy, improves and strengthens, we can see, kind of the decline in people, going to 2 years, and an increase in people just entering the workforce straight out of school. And so I think that's kind of one of the interesting trends that we see for young people. 4-year institutions have stayed relatively steady kind of in Missouri over the course of the last 2 decades. So of the workers, of the new workers, young people entering the workforce, what do they actually do? What kind of work do they actually, go into? And so the chart on the left basically shows employment by sector in Missouri for people ages 14 to 18. So I think we can, think about these folks who's people who are kind of working while they're in high school for the most part, whether it's a summer job or while they're in school. And those jobs that they tend to find, 2/3 to, probably 2/3 of those jobs tend to be in either food service and accommodation or retail. And then, a small sliver of people are in healthcare, and then, about a quarter are in kind of all other type activities. And these work, I think it's safe to say that these work experiences are important, because even though they might not be career-oriented jobs, but they're important because they're often, for a young person, their first exposure to the workplace. If we look at, and where they learn things of like showing up to work on time and how to, interact with people in a workplace. And so they're good experiences on that front. As we, and so I think one of the challenges over the course of the last year is that, those 2 sectors, retail, food service, are some of the kind of been most impacted by the pandemic. So I think it's kind of hurt people in getting those experiences. Those opportunities may have been more limited. When we move to the chart on the pie chart on the right over here, and we begin to look at, what happens to 19 to 21-year-olds. So people who basically left high school and entered the workforce, and you begin to see a bit of a shift. So food service and retail are still about half of the employment. But then you begin to see people going into industries with greater career opportunities like healthcare, manufacturing, construction is in there as well. And where there's a lot of different places to enter. I mean, these type of industries where there's opportunities to enter with a high school degree, or maybe a high school degree and some additional training. So in any case, I think, I think as we think about, what's happened over the last year, that there's been, a lot of missed work opportunities for young folks in across the country, in both in Missouri and across the country in 2020. What I have here is, again, this is the employment to population ratio this is nationwide, for people ages 16 to 17 and people ages 18 to 19. Obviously, people ages 18 to 19 are far more engaged in the workforce than than those 16 to 17 just as a group. And for 18 to 19, it seems to be those opportunities going through February in this case are kind of back to pre-pandemic levels, maybe not solidly back to pre-pandemic levels, but they're getting back there. And the 16 to 17-year-olds are almost there. So if we're looking for some good news, I think we're trending in the right direction. But again, thinking of the things that were, not the things that were lost in 2020, I think were a lot of work opportunities for younger folks. So where are things headed as we, shift, maybe think a little bit about looking ever so cautiously into the future. And I would say I am not a forecaster, nor do I have a crystal ball. But I think there's a few things that we can look at to help think a little bit about where things might be headed. So if we look at initial unemployment insurance claims in the state of Missouri, they still remain higher than, I guess, I say quote unquote normal, or what we used to think of as normal. And that, it's certainly slowed from during last April and late March and April when things were, when the sky was falling. But we're still, the weekly UI claims are still double where they were a year ago. So that's not great. There were 137,000 some odd UI claims so far in 2020. But as we, again, just to reiterate, I think we're at the beginning of the end. So the hope is that will continue to go down. So we still a lot of work to be done. Another thing that we, can look at to get a sense of what's happening in terms of hiring is that we can look at a number of online job advertisements. And this is through a data source called Burning Glass Technologies. Basically, it goes out every day and pulls down online job advertisements and counts them and categorizes them. It can be a really useful data source, but it's important to know that particularly when it comes to things like construction and manufacturing, a lot of jobs are not advertised online. So it's by no means kind of a full accounting of the job opportunities in the labor market. That said, in the last 30 days or so, we have this weekly through, I guess, last week, through the 19th, that there has been an increase in job advertisements that we're seeing. So this can be really spiky. So what I did was I just took like a 4-week rolling average of job advertisements, both in St. Louis, in Kansas City, and then we'll call outstate Missouri, which is basically the rest of Missouri. And what you see is in the last 30 days, things have really started to pick up in St. Louis. Since the beginning of the year, things have started to kind of really increase in terms of the number of job opportunities that are available. And as you look to where you are on the right of this chart, as opposed to the left of the chart, the left, you can see where we were a year ago when the bottom fell out to where we are today. So I think that's kind of hopeful. In the last 30 days, we've seen, the most job postings have come from things like hospitals, bars and restaurants, and professional scientific and technical services. And the important caveat that I'll offer is that these, tend to be the industries that typically advertise a lot. Healthcare, there's always demand, and they're always advertising online. But again, it's nice to see, bars and restaurants starting to hire again. So hopefully that's an optimistic sign of what's coming as we move, more into the spring and early summer, that recovery is around the way. And that tends to be the general consensus when you're, if you're just kind of looking around in the kind of whatever the business press is, that, the world economy is projected to grow quite a bit in 21 and 22, due to, obviously the kind of rollout of the vaccinations is hugely important. And then, as we think of additional policy support and, for instance, $1.9 trillion in kind of, both vaccine and other kind of economic stimulus coming down the economic recovery funding coming down the pike. So whether you're looking in Forbes or whether you're looking for publications from like the OECD, for instance, I think there tends to be a certain amount of optimism about what happens now. Obviously, there's a lot of things that can slow that down. Different, variants of the virus that can cause headaches, or not rolling the vaccine out successfully. We worry about Missouri and we worry about the United States, but it's also we live in a global world, so it's important that the Europeans get things sorted out, and in Africa and Asia and elsewhere around the country that gets all figured out as well. So in any case, I'll stop talking here in a minute, and we can do any questions. But the key takeaways is that the employment picture looks a lot better than it did a year ago, which again, going back and looking at the presentation I did last year, man, that was grim. But we still, we're out of the pandemic sized hole, and now we're just in a Great Recession sized hole that we have to dig out of. So there's a lot of work that needs to be done. The losses in Missouri were not as severe as other neighboring states, but we really need our big metro areas to bounce back. For a lot of folks too, recovery in the kind of the leisure and hospitality sector, which is experienced the greatest losses across the state, will be important. And a lot of that will come just in the number of shots that go into arms, as much as anything, and how comfortable people are in going out again, particularly in the urban areas. The rebound in the construction industry will rely on again, demand in those big metro areas, particularly in the trades. And yeah, we tend to be pretty. I think people tend to be pretty optimistic, but a lot depends on how many vaccinations we have, and the impact of stimulus and recovery funding. So with that, I'll shut up, and if anyone has any questions that they want to ask,